Want to know a secret the richest families in history figured out centuries ago? They didn't build factories. They didn't sell products. They did something much simpler. They owned banks. Because a bank is basically a machine that prints money out of thin air. Sounds like a fairy tale, right? But here's the dark side of that fairy tale. The exact same banks that make people unbelievably rich can collapse overnight and take billions of dollars of other people's money down with them. By the end of this video, you'll understand exactly how a bank makes money off you every single day, even when you're just sitting there doing nothing. And you'll understand why a bank with 40 years of history can vanish in 44 hours. Stick around. This one gets wild. Part 1. What a bank actually does with your money. Most people picture a bank like a giant safe with a security guard. You walk in, you hand over your cash, they protect it. You take it out whenever you need it. But that's not a bank, that's a locker. A real bank does something completely different. It takes your money and puts it to work immediately. Think of it like a bakery. A bakery takes flour and turns it into bread. A bank takes your deposit and turns it into loans for someone else. And here's the strange part. When a bakery sells bread, the flour is gone. When a bank lends out your money doesn't disappear. You open the app, it's still there. You could withdraw it right now if you wanted to. But most of it has already been lent to someone else. This isn't a scam. It has a name. Fractional reserve banking. And it's the foundation of pretty much every modern economy on Earth. Part 2. How $100 becomes $1,000. Let's break this down slowly, because this is where it gets interesting. You deposit $100 into a bank. The bank doesn't lock all $100 in a vault. For most of American history, banks were only required to keep $10 in reserve. The other $90 they lend out. That $90 gets spent. It lands in someone else's bank account. That bank keeps a small piece and lends out the rest again. And the cycle repeats, over and over. By the time the dust settles, your original $100 has quietly become $900, maybe even $1,000 circulating through the entire economy. This isn't magic. It's just math. In 2020, the United States actually removed this reserve requirement completely. Banks today decide for themselves how much to keep on hand. But the core truth never changed. The entire system runs on trust. It only works if not everyone tries to withdraw their money at the same time. So what happens when that trust breaks? Hold that thought. It matters more than you think. Part 3. The real cost of owning a bank. You think opening a bank means renting a nice building and putting up a sign? Not even close. Before you accept a single dollar from a customer, you need to spend somewhere between $2 and $30 million, and you'll wait 1 to 3 years just filling out paperwork. You need approval from at least 2 separate government agencies. You need special insurance for your customers' deposits, or nobody will trust you with their money in the first place. And on top of all that, you need your own personal capital, money that belongs to the bank, not to your customers. Think of it as a safety cushion for when things go wrong. If you want to lend out $100 million, you need to walk in with $10 to $15 million of your own money. And you can't borrow that money. It has to be yours. You haven't made a single loan yet. You've just paid for permission to try. Part 4. The bills that never stop coming. Okay, the bank is finally open. Now the real pain begins. First, people. You need loan officers, security teams, lawyers, IT staff. Even a small bank spends millions of dollars a year just on salaries. A giant bank like JPMorgan Chase spent more than $22 billion on expenses in a single quarter. Second, technology. Every transaction has to be protected from fraud and hackers. One single data breach can cost hundreds of millions of dollars in fines and lost customers. Third, paperwork and regulation. Banking is one of the most heavily monitored industries on the planet. Endless reports, endless audits, endless legal reviews. Fourth, bad loans. Some borrowers simply won't pay you back. Someone loses their job. A business collapses. Banks have to set aside money in advance, just in case. And only after all of that do we finally get to the part everyone actually wants to know. How does a bank make money? Part 5. The secret engine behind bank profits. Here's the simple version. A bank takes your money for almost nothing and lends it to someone else for a lot more. That difference? That's the entire engine of banking. Your savings account pays you barely anything. Meanwhile, a car loan or a mortgage can charge someone 6 to 20% interest. The bank sits right in the middle and pockets the gap. But that's not the only trick up their sleeve. Every time you swipe your card at a store, that store pays the bank a small fee. Every wire transfer, every late payment, every tiny little transaction, the bank takes a slice. Late payment fees alone generated almost $10 billion for American banks in a single year. Now multiply tiny percentages across trillions of dollars flowing through the entire country. You get numbers that don't even feel real. In 2024, JP Morgan Chase made $58 billion in profit. In 1 year, the largest annual profit in the history of American banking. Part 6. The trap nobody talks about. And now, here's the single most important thing you need to understand from this entire video. A normal business uses its own money. A bank runs almost entirely on other people's money, yours. This is called leverage, and it's the exact same thing that makes banking incredibly profitable and incredibly dangerous. Picture a bank holding $50 billion in customer deposits, but only $5 billion of its own money. That bank only needs to lose $5 billion to become officially insolvent. $5 billion out of 50 is only 10%. This is exactly why banks that look completely rock solid can collapse in a single night. And now you're about to see 2 real examples that are genuinely terrifying. Part 7. The bank that disappeared in 10 days. Meet Kerry Killinger. For 17 years, he ran Washington Mutual, the largest savings bank in America. Over 2,200 branches, 43,000 employees, $188 billion in deposits. This man understood banking inside and out. But his bank had pushed heavily into risky mortgage loans given to people with poor credit, charging higher interest to cover the risk. As long as home prices kept rising, the math worked perfectly. Then in 2006, home prices started falling. People stopped being able to pay their mortgages because selling their homes no longer covered what they owed. On September 15, 2008, Lehman Brothers collapsed, the largest bankruptcy in American history. The news hit the financial world like a punch to the gut. Washington Mutual's customers panicked. Over the next 10 days, they pulled nearly $17 billion out of their accounts. The government had to step in and sell the entire bank to JP Morgan Chase for just $1.9 billion. A bank worth $188 billion in deposits sold for less than $2 billion. So here's the question. How does someone who spent 17 years building one of the biggest banks in America watch it collapse this fast? The answer is chilling. It wasn't really about him at all. It was about the entire system. Part 8. The bank that vanished in 44 hours. But the next story is even scarier. Silicon Valley Bank. $209 billion in assets. 40 years in business. The 16th largest bank in America. Gone in 44 hours. This bank mostly served tech startups. During the pandemic, when startups had piles of extra cash, the bank invested that money into government bonds, the safest asset on the planet. The risk wasn't that the bonds were dangerous. The problem was time. When the Federal Reserve started aggressively raising interest rates in 2022, the value of those safe bonds started dropping fast. By the end of 2022, the bank was sitting on $17 billion in hidden losses. On March 8, 2023, the bank announced it was selling some of those bonds at a loss and trying to raise emergency cash. That single announcement lit the fuse. Venture capitalists started texting each other. One major investment fund pulled every single dollar out immediately. Others followed within hours. In a single day, customers tried to withdraw $42 billion. Nearly a quarter of the entire bank's deposits gone. On March 10th, regulators shut the bank down completely. What actually destroyed Silicon Valley Bank wasn't bad loans. It was pure panic, spreading at the speed of a group chat. Part 9. Why this could happen to any bank. You could have the smartest team on earth, perfect spreadsheets, flawless math, and it can still all collapse because of one thing changing: interest rates. When rates go up, what a bank pays depositors goes up immediately. but old loans keep paying the same low rate they always did. That gap doesn't always show up right away. Washington Mutual looked completely fine until it wasn't. Silicon Valley Bank looked completely fine until it wasn't. Both banks were run by experienced professionals who had survived previous financial storms. Both banks were making money right up until the exact moment they stopped existing, closing. So if you ever dream of owning your own bank, remember this. You're not buying a vault. You're not buying steady, predictable income. You're buying a machine that turns human trust into money. And that machine only works as long as the trust never disappears. The moment it does, no amount of capital in the world moves fast enough to save you. If this video just changed the way you look at your own bank account, hit subscribe, because the next story is even crazier.